Chadha joins us, needs no introduction. He's an all India hand. He understands Indian markets, more than anybody else. Rahul, fantastic to have you back. Thank you for joining us. Rahul, in January, nobody thought that we could see this ugly sell-off like what we saw in the month of March. And in March, nobody thought that we would be celebrating these levels for Indian markets and for global markets. What is the right market? The one we are reporting right now, or the one which we saw in the month of March? What's your sense?
Okay, because markets are going to be fairly volatile, and I think this is what we've discussed before also. See, on one hand, which is the positive impetus, this is the strong policy support we've got. Unlike GFC, which was a financial crisis, which was endogenous shock, which took a while to, where economies took a while to come out of it. This is exogenous shock, so that's where policymakers have come very quickly to kind of stabilize the economy. You look at the amount of stimulus US has given, nearly 20-25% of the GDP. You look at what's happened in Eurozone and what's more going to happen. I think that's where, again, markets are getting kind of positively surprised. What's happening is markets are trading the end of lockdown and the resumption of activity. And that's where we saw a lot of these gains over the last 2 months. How do we play out from here? I think what we play is how much do the normalization we get? Is it 60%? Is it 70%? Is it 80%? And this would be a number which would vary across economies, across sectors, and that's where the stocks would go and settle over the next 6 to 9 months. A key variable in this is the second wave of infections. I think that's where you're seeing a bit softness in regional markets, and India included, that we've seen a second wave emerge in Beijing, where they've locked down the parts of the city. So that would be clearly negative from a market perspective. But look, if we see people living with the coronavirus and reasonably decent healthcare facilities, then the market will again go back and focus on stocks and their fundamentals. But this is for next 6 to 9 months. Over 3 to 4 years, obviously, fundamentals would dominate and influence a lot more.
Rahul, everyone we've interacted with has one simple explanation to why markets have gone higher. Liquidity, liquidity, liquidity. Now, if interest rates are likely to remain low for a long time and liquidity is going to be abundant for next couple of months, quarters, or it could be years, then what is the end game? Just because there is liquidity, do you think stock prices and equity prices will keep on going higher? Because if the fundamental plank of the market is a bit shaky on the economy front, on the earnings front, and if it is only liquidity which is taking higher, then guess what? Liquidity, there's no dearth to liquidity.
See, liquidity cannot really kind of take market higher always. I mean, we've seen how the old bubbles burst, whether it was March 2000 or whether it was 2007, 8, etc. So liquidity was there. There's much more now. But look, why this liquidity takes the market higher is because there's a hope that earnings would follow through. And if we see coming out of recession, the first year is normally the returns are led by the earnings re-rating, and the next year earnings follow through. So eventually earnings have to follow through, and it's as simple as that. Which is where again I come back to what I was saying, that it's really a function of normalization of the economy. What happens is, because we've got low interest rates, because we have this uneven recovery across countries, across sectors. Some countries, some sectors may trade expensive compared to their usual valuations, etc. And then over next 2-3 years, as we see probably post-vaccine normalization coming through, that's where the valuation kind of a catch-up within sectors would happen.
What has been your India positioning? Last time when we interacted with you, you said that you were looking at buying more insurance stocks. In this decline, have you added more to your insurance exposure? There were a couple of block deals which have also happened in the insurance space. Did you participate in them?
Okay. So again, when we chatted, and that was a good time to buy into the financials, the insurance. I think, if I'm not mistaken, that was last week of March, and that was a time when there were extreme pessimism around. So we added to, again, our financial sector exposure there. And look, we added with a view that, look, we don't know how the returns would be in 6 months' time, but over the next 1 or 2 years, from those levels, risk reward would be favorable. Insurance have played out more than banks. And banks, obviously, in terms of returns, have lagged because the extent of lockdown in India because of COVID is much longer, more so for kind of a key economic regions like Delhi, Mumbai, Tamil Nadu, etc. Obviously, the lockdown is a lot more severe. The coronavirus cases spread is a lot more severe than expected. So insurance have performed up to expectations. Banks obviously have lagged because of this.
In your current emerging market allocation, are you looking at increasing your exposure to India? Are you likely to maintain status quo?
Overweight India. Look, that's not really helped for last couple of months, but we're taking a longer term view. And the genesis of this view was that if you look at Jan-Feb, there was a strong recovery which was building. I mean, there are a number of anecdotes on that, whether you see same-store sales growth for some of these QSR companies like Westlife, or whether you look at real estate sales from Prestige, etc. All these numbers were picking up in the economy, and obviously the forex reserves had built up by 17-18%. There was ample liquidity, so there was an economy on the mend, on the recovery, and that's where you make money. And we were positioned for that. Where we were negatively surprised, honestly, was that, look, we expected coronavirus to be controlled after one of the most severe lockdowns in the world. What's happened in Delhi, Mumbai is disappointing. So you hope that with centers' help, these states, these regions are able to continue or mitigate the impact of coronavirus or control the spread of coronavirus. So that should be positive. And I think once that happens, then and as economies come back to normalization, we believe that India should benefit and should emerge strongly out of this over the next 1 or 2 years. Because look, the FI ownership for India is amongst the lowest has been in last 10 years. India's premium to rest of the emerging market is lowest, whereas the stories got better in terms of productivity improvement, in terms of infrastructure, and all these things which have happened over the last 3 years. The economy has gone through the pain of GST implementation. The interest rates are low, and with this world of surplus capital, India benefits the most. But all that comes to India only when coronavirus is controlled. See, nobody's going to invest in India if Mumbai and Delhi are in such bad shape. So I think it's very important that both center and state work together and make sure that the coronavirus situation comes under control, at least in the key economic regions.
But in general, have you participated in any of the large blocks which have happened, whether it is a Bharti or a HDFC Life? A lot of promoters have used this current market either to raise capital or to offload their equity.
So I would not comment on specific deals, but look, these are the names we like. We like insurance pack, we like the telecom space, and wherever we've got attractive valuations, we've increased and added to our exposure.
What is your definition of being attractive or called attractive in the private banking space? Because there are two ends in the private banking space. IndusInd Bank, which has got smashed to a price to book of less than 2 times, and HDFC Bank, which has not even corrected below 3 times even once in this crisis. So what is the definition of attractiveness? Okay,
so first and foremost is, look, we all know these are uncertain times, and the longer this coronavirus pain continues, the more it is going to be painful for weaker businesses and the banks who lend to the weaker kind of entities in the system, which is why from our financial exposure perspective, we've been to leading private banks, and we're willing to pay a premium, whether it's for HDFC Bank, ICICI Bank, or Axis, Kotak, etc. And that's where we've kind of had bulk of our exposure to. So our point is, look, these are uncertain times. We can generate alpha by being overweight these names rather than going down the curve, because one is not sure how much would be the pain at middle or bottom of the economic system, and how does that pain transmit to the banks which are exposed to these entities.
A lot of investors are currently, in a sense, queuing up to either invest in Jio or, for that matter, even in Bharti. Some are investing in both. But as an equity investor, not as a private investor, when you are buying in the Indian telecom stocks, which a lot of investors have done, and I would imagine in your case also, Do you think one should not get carried away because of the new normal in terms of dependence on telecom and digital? Because for the telecom sector, there is a problem. And the minute I speak this three-letter, abbreviation AGR, it just makes you wonder that where those companies are headed.
So from our telecom sector exposure, it's largely through Bharti. Reliance is a proxy for us from a super app formation, and that's something which is work in progress. But having invested in the likes of Alibaba, Tencent, Meituan, and seen how much value they've created over 5 to 7 years, we believe that Reliance is capable of doing that in India through the Jio, through the retail platform. So that's what one is playing in Reliance, and this is something one's been tracking for last 4-5 years, and which is why Reliance would be one of our top 5 holdings. So we continue to like Reliance for the bigger story, which is really replicating what the Tencents, what the Alibabas, what the Meituans have done in China, basically from a super app perspective.
Rahul, where to your mind markets are still too pessimistic? Is it aviation? Is it multiplexes? Is it hotels? Not everything in the aviation sector will go down. Not every multiplex will go under. Tourism industry will pick up. I mean, when things normalize, I would love to come to Hong Kong and meet you personally and maybe have a cup of coffee, in one of the restaurants in Hong Kong. But right now, the stocks are getting smashed as if nobody will travel, nobody will go out for holidays, and nobody will watch movies. Are you looking at the bombed out spaces to pick up something?
Okay, so I think something in the 3 spaces which you talked about, which is multiplexes, airlines, hotels. What we like is hotels. Clearly, what we were seeing in China also was domestic tourism pickup. See, this is something we've seen on ground in Hong Kong, Korea, China, that people are sick and tired of sitting in their homes or bottle up in their homes for 3 to 4 months. So the first thing they do is, if the number of cases stabilizes, go visit the malls, go visit the restaurants, and then next day thing which is popular in Hong Kong is staycations, which is where your hotels benefit. And then subsequently, as you get more confidence, you do international travel and all these things, etc. Multiplexes again thrive on occupancies. More so, large part of that occupancy comes over the weekends. So I think till the time you have a vaccine being found for coronavirus, obviously those occupancy rates would be much lower over the weekends, etc. And with these OTT gaining traction, that may be a threat for the business. But clearly, hotels at the bottom of the cycle, and looking at the fact that these names have not done anything for 10 years, look very attractive. These are hard assets, tough to replicate. And once things improve, you will see these guys have disproportionate earning power.
There are a lot of folks, Rahul, including some of your peers, who are now of the view that it's time to take a deep dive, which is look at deep value stocks, companies which are trading below their book, below the intrinsic value, whether it is cement or whether it is steel, whether it's a combination of 1 or 2 PSUs. Are you looking at that space? Because the businesses where everybody is investing in right now, everybody is investing, the darlings of the market, are the ones where pricing is really at a crazy level. Are you looking at the market cycle turning and churning, and typical deep value or value investing could make a comeback in 12 to 18 months?
Scenario. I mean, if you ask me probabilities of it, I would rate it as 60-65%. Say over next 2-3 quarters, if we keep getting extensive lockdowns because of second wave, then obviously you will have deflation prevail, but that's not the base case scenario. From a base case scenario, as this liquidity goes in the world, as you see velocity of money picking up, as you see the much needed stimulus from, let's say, big economies, largely Eurozone coming through, there is a talk of anywhere between $1 trillion to $1.5 trillion stimulus which comes, because after 10 years, the Germans have agreed to a little fiscal union for European Union. So if that comes through, it's highly likely inflation comes back. And with that coming back, a lot of these value names, whether it's a Coal India, whether it's a OMCs, are very, very attractive. So we have that in our portfolio. It's not done much for 6 months, but again, these are monopolies. These are not bad businesses. The cash flows are good. The balance sheets are good, and that's why we invested in the top quality value names. And we believe that, look, as you see these fears of deflation recede and inflation come back, these names may be multi-bagger over the next 3-4 years. So these are good businesses. It's just that they were out of favor. So if you look at our positioning, again, we would be underweight consumer staples, we are underweight IT, and overweight parts of consumer discretionary, financials, some of these value basket you may call.
Aren't you taking a lot of risk? Because some would argue that in this kind of an environment, one should avoid companies which have debt on them, companies which are linked to cyclical recovery. A lot of investors are still, they continue to take comfort in a DMart or for that matter an HDFC bank. I know you've always taken a lot of pride in having a classical and a differentiated value approach. But Rahul, the value investing theory is getting more and more debunked in a market like this.
Okay, so again, let's look at the construct of the portfolio. If you're looking at financials, what we have exposure to is the best banks, which would be the likes of HDFC Bank, Kota, ICICI, etc. So obviously that's as pristine as it gets over there. If you look at value, one is not really buying, too many stretched vulnerable balance sheets. You're not buying weak promoter groups. What you're buying here is government monopolies, the OMCs or the Coal Indias, which have enough cash on the book and which are free cash flow generating, and all these companies. Similarly, from a cyclical exposure, large part of the exposure would be through cement companies, which have not done anything for the last 2-3 years. Decent balance sheets. They delevered their balance sheets over there, and you're particularly mindful of the balance sheets over. So I think that's what one is trying to play. That one is trying to play operating leverage, not financial leverage, because like the way you said, no one's got a clue on the second wave of this virus, if at all it comes, how meaningful it's going to be, and whether governments are forced to do the lockdowns again. See, again, our view for India remains that, look, there are close to 25,000 deaths every day in India. So till the time the number of daily deaths go to about 1,000, governments will do all the measures but not do lockdowns. It's going to be specific containment zones, etc. But I think the big risk, obviously, to this whole is if you see large-scale lockdowns coming back.
Now, we've not had a breakthrough on the vaccine front, Rahul, but markets, they tend to start pricing in the minute you hear from some of the global pharma majors that at what stage the clinical trial is. Do you think markets are secretly pricing in by year end there is going to be a victory on the vaccine front, and by next year or middle of next year mass production would be out? Is that something which markets are really working with as a template, and any slippage on that, and if we get any bad news on vaccine front, that's going to set cat amongst the pigeons?
Not really, Nikuj. At this point of time, what the markets are pricing or looking at is countries after countries coming out of the lockdown and the resumption of activity over there. So you look at this, typically what happens is markets do well when your PMIs improve. The PMIs are improving from your 40s coming to 50s. So I think there is a bit of a normalization trade which is going on. The rest of this normalization trade, as I said, was obviously the pent-up demand is lower than expected, or the consumer who is at the forefront of this normalization trade gets risk averse again because of this second wave of viruses, etc. So that's the thing. I think come September, October, 10-15% higher, that's where the market would clamor for or ask for any clarity on the vaccines. And that's where it's important that between September to December, we get some clarity on the vaccine.
I was speaking with someone in Morgan Stanley, and this is something which will be music to your ears. According to Morgan Stanley, Rahul, emerging markets have had perhaps low returns and no returns in dollar terms in last couple of years. And if one goes by the cycle and if one goes by historical averages, emerging markets should make a comeback with a strong double-digit CAGR return for next 3 to 4 years. Is that logical? Is that possible that US markets may take a back seat and emerging markets may make a comeback because the trend has already started with the weakness in dollar?
Right, Nikuj, on this. And look, we can say this with confidence only 2 years later, but I'll give you anecdotes, and this is something we discuss in the team. You look at the ownership of FANGs, it's a record high. You look at the euphoria for US markets, you look at how complacent people are with the investments in US markets. So obviously these are telltale signs, and again with the printing of dollars, obviously that leads to a weakness in dollars. What's also happened is with European Union coming together in terms of a credible, sizable response, obviously that would also reduce the risk aversion in the world. That would lead to the reflations of the global economy, etc. So I think that backdrop from an EM return is well set up. But look, EMs are always a high beta play on global growth revival. EMs are always a high beta play on inflation coming back, or at least deflation not being there, which is where next couple of quarters are going to be choppy till the time we get clarity on this coronavirus-led negative impacts on economies. But as you see more and more clarity, very clear EMs are under-owned in portfolios. They should give good returns because valuations in DMs are expensive, investors are complacent, and as things pick up for EMs, obviously you have a self-fulfilling positive cycle which plays through.
Rahul, over the years, what I've learned from old-timers like yours is that markets, they never react to the same thing twice. So while there is a serious concern that the second wave of coronavirus may come out, and even if it does, we all are hoping and praying that that does not hold true. But even if it does, do you think markets are unlikely to collapse the way they did in the month of March?
So again, you need something more severe than what you saw. So I think that's a great point you made, that look, we saw that in trade war. We saw that in trade war because it was something new in terms of the tariffs which were put on China. That's where the market reacted. Initially, they took it in the stride, the rhetoric between US and China. Similarly, in coronavirus, markets have seen the cases, etc., all these things. So which is where I think nobody's looking at those cases with that seriousness anymore. What one is, from a market perspective, looking at is the number of deaths. So what one is watching is that, look, does the pain reaches to such a level that the policymakers also come and close the economy? So from a market perspective, extensive shutdowns are bad because obviously then you can have large-scale bankruptcies, then you cannot focus on your fundamental 10-year, 20-year stories, etc. So all those things. So I think the case count, obviously people look at that, but it's not the single most important factor. What is important factor is really the number of deaths, and again, whether you have ample medical facilities to take care of the people who need hospitalization, etc.
So final question, Rahul, given that it's not going to be a one-way street between US and China in terms of trade relations. We know the challenges which have happened in terms of the political challenges in Hong Kong now. Where does India fit in? Because for an outside investor who has to choose between India and China, if you're investing in China, you are taking a risk on the political front, you're taking a risk on the economy front, you're also taking a risk in terms of the trade front.
So India is very attractive from a 3-year perspective, but look, what can happen is a lot of the gains can be back-ended if we don't control coronavirus in Delhi, Mumbai. It's as simple as that. See, these are the two cities which stand out for our foreign investors. And when two of your most important cities are under so much pain, so much pressure, obviously investors also see and wonder that are we in control of things? So leave aside the big talk which comes, but are we in control of things? So which is why it's very important that center comes to the support of the states in both these regions and fixes coronavirus in terms of ample medical facilities, etc. And once that comes through, people will then again focus on the merits of investing in India from a medium-term perspective.
Well, Rahul, really appreciate your time. Thank you for a candid chat. We started with the world view on a top-down basis. We've discussed politics. We've been focusing on sectors and themes you like. So really appreciate your time. Stay safe, my friend. And I'm really hoping that the day comes soon where I meet you in Mumbai for a coffee when you come here, or I come to Hong Kong and we meet for a coffee in Hong Kong. So stay safe, my friend, and thank you for joining us.
Yeah, thanks for having me, and stay safe, all your team and all your viewers. Bye.